Hello students, welcome to my class. This is Professor Vincent Osaya and this is part 3 of chapter 1 presentation, accounting by the Leases. So this is where we left off in part 2. We indicated that if a lease is considered as a capital lease, we need to recognize or record the asset and the related liability. And we said that both of them are accounted for or recognized differently. So let's take a look at what we said in part 2. We said that we should record the assets and liability at the lower of these two amounts: the present value of the minimum lease payment or the fair market value of the lease asset. The rationale behind this rule is we want to prevent recording the asset at more than fair market value. Hence, we said that we need to record it at the lower of the fair market value or the present value of the minimum lease payment. So, moving along, additional issues relative to accounting by the lessee and accounting for assets and liabilities differently. We said that here's additional rules that you need to know. If the lease, in other words, the lease contract transfer ownership to the lessee, then the lessee needs to depreciate the assets over the economic life of the asset. Don't forget now, even though this is a lease, the lessee is treating it as if the asset was purchased. Hence, we are recording it as an asset in our books and also recording the related liability. So therefore, if we are recording it as if we purchase it, then we have to depreciate the equipment or the property as well. So, how do we depreciate the property? That is the rule here. If the ownership transfers to the lessee at the end of the lease term, then we need to depreciate that property over the useful life or the economic life of the asset. If the lease does not transfer ownership, then we depreciate the lease based on the term of the lease. For example, the lease might be 3 years lease or 6 years lease, so on and so forth. Moving along, additional rules relative to asset and liability accounted for differently. Effective interest method. We use the effective interest method to allocate each lease payment between principal and interest. Remember in chapter 15, chapter 14 or 15, when we talk about bond accounting, and we talk about two different methods of recognizing the interest component of the payment. We said that, or amortizing the discount or the premium, we said we either use the effective interest method or we use the straight line method. Here we are using the effective interest method, and we are going to explain that a little bit more in a minute. Then the depreciation concept. The depreciation and the discharge of the obligations are independent accounting processes. Now, let's take a look at an example that will illustrate all these bunch of rules that we have talked about regarding how to account for a lease from the lessee standpoint. So I hope you can see this on the screen, otherwise you might have to take a look at your PowerPoint slide yourself. So C, sign a lease agreement dated January 1, 2014 that calls for C to lease a front-end loader to S beginning January 1, 2014. The terms and provisions of the lease agreement and other pertinent data are as follows. So, number 1, the term of the lease is 5 years. The lease agreement is not cancelable, requiring equal rental payment of $25,981.62 at the beginning of each year. Annuity due, meaning the first payment is going to start at the beginning of the contractual period. Then, number 2, the loader, that is the property, has a fair value at the inception of the lease of $100,000, an estimated economic life of 5 years, and no residual value. S pays all the executory costs directly to third parties except for the property taxes of $2,000 per year, which is included as part of his annual payment to C. The lease contains no renewal options. The property or loader revised to C at the termination of the lease. S, incremental borrowing rate is 11% per year. S, depreciates on a straight line basis similar equipment that it owns. Then C sets the annual rental to earn a rate of return on its investment of 10% per year. S knows this part. So let's take a look at how all the pieces work. So the first thing is this a capital lease or operating lease? If it is a capital lease, then it needs to be accounted for as such. And we are going to go through the 4 criteria. Number 1, transfer of ownership. No, there is no transfer of ownership. Number 2, bargain purchase option. There is no bargain purchase option. Number 3, let's take a look at the 75% rule. The lease term is 5 years. The economic life is 5 years. That is 100%. So bingo, this is a capital lease because the lease term is more than 75% obviously of the economic life of the equipment. And number 4, it doesn't matter now because we are one of the 4 criteria has been met. Number 4, the present value of the minimum lease payment is greater than 90% of the fair market value. The present value is 90, and the present value of the minimum lease payment is 100,000. The fair market value is also 100,000. So clearly that criterion is also met. So let's take a look at how we compute the present value of the minimum lease payment. The payment is $25,981, and the property taxes, part of the executive cost, is $2,000. Remember, we said that that is not part. The executory costs are not taken into consideration in calculating the present value of the minimum lease payment. So we back out the $22,000. Then the minimum lease payment is $23,981.62. So we calculate the present value of $23,981 over 5 years. Again, this is annuity due. So if you take a look at the table, the present value interest factor is 4.16986. So when we do the math, guess what? The present value of the minimum lease payment is $100,000. So like we said, we recognize or we record the asset and the related liability based on the present value of the minimum lease payment, in this case $100,000, or the fair market value of the fair market value of the property, whichever is lower. In this case, the fair market value and the present value of the minimum lease payment are the same. So we are going to debit lease equipment for $100,000 and credit a lease liability for $100,000. That is on January 1st. Now, on January 1st, take a look at the first lease payment, because we said that this is annuity due. The first payment has to be, the first payment is required to be made at the beginning of the lease term. So the property tax expense is $2,000. Again, we are still talking about accounting from the lessee standpoint. So the property tax expense is $2,000. The lease liability is $23,981. Cash is $25,981. As you can see, interest is not a factor here because the time, there is no elapse of time. In other words, this is the beginning of the lease and the payment was done. So there is no justification for recognizing interest because no time has expired. Now, take a look at this table, the lease amortization table. It is very important for you to be very comfortable with this table. Take a look at the first column, the date. The second column is the annual lease payment. So, and the lease liability is $100,000. Now, this is the beginning 1-1. So, on the January 1st, 2014, we paid $2,981. Of course, the executive cost is $2,000. The interest component is non-existent, like we explained. And the reduction of lease liability is $23,000. So the lease liability is reduced by $23,981, excluding the executory cost. Take a look at the next payment. This is what you need to pay attention to. The next payment of $25,961, of course, the $2,000 executory cost is back out. So we are going to, the interest rate is 10%. Remember the interest rate rule, we use the lessee incremental borrowing rate, or we use the lessor implicit interest rate, whichever is lower. So in this case, as we established when we went through the first, the lessor's rate is 10% and the lessee's incremental borrowing rate is 11%. So we are using 10%, that is the lessor's implicit interest rate, because it is lower than that of the lessor. So to figure out the interest on the second payment, take a look at what we did, just like we did for bond accounting. We multiply 10% by the balance of the lease liability of 76,000, and that gives you 7,601. So that is the interest component of the amount that was paid. So the second year we paid 25,000, $2,000 is executive cost, 7,601 is the interest portion, 16,379 is the principal or liability reduction. So that would be the conclusion of part 3, and we will take it from there in part 4.